In this video, we are going to look into the basics of accounting, the very basic of accounting, how it started. So even going into the theoretical part of how accounting started and the history of accounting and the concepts, how we can easily start on with working out accounting through journal, ledger, or the other steps. So the basic information which you require as an accountant to start working accounting is you must know the process of accounting. So the process of accounting starts from the business. So when a person starts a business, he will do a transaction or he will perform an activity. So the activity which he performs, for example, if you are starting a business, you will either purchase raw materials or you will either sell a product which you produce to the consumers. So let's consider the activity to be purchase or sales. So these activities in accounting terms are known as transactions. So if you take a transaction, there are two types of transaction. One may be cash transaction, that is cash may be involved in the transaction. For example, you went and purchased a pen for 5 rupees. So you have paid the person 5 rupees. Cash was involved. Another set of transactions are credit transaction. That means you did not pay cash to the dealer or the person who sells it. You have brought it on credit, saying that you will ensure the payment in future dates. So the two types of transactions are going to happen when you start a business. After the transaction has happened, you are going to analyze the transaction. So purchased, so you have purchased this pen. So you have given money for it. So what has happened exactly in the transaction will be analyzed by the third person called as an accountant. After analyzing the transaction, the accountant will split it into debit concept and credit concept. So these two are very important in accounting. It is essential for us to know what is a debit and a credit. So maximum, if you see, debit represents the receiving aspect of a transaction, whereas credit will represent the giving aspect of the transaction. So these are just representatives of that particular nature of the transaction. So next, after determining the debit and the credit concept, next he will record it in a book of entry known as journal. So after the analysis part, you will start the book entry. That is entering or recording it into the books of entry. So the first book of entry will be the journal, which is a basic book of entry which every organization will maintain. In the journal, the transaction which was performed, which was analyzed by the accountant and split it up into debit and credit concept, will be recorded as a journal entry in the book of a journal. After journalizing the transaction will be posted into something called as a ledger. The ledger maintains the postings of the journal into various accounts. So this is where we must come to know what is an account. Account means a summary of a particular item. It gives you a summary of a particular item. For example, if it's going to be cash and the business have maintained for about 5 cash entries, that is dealings with cash. So those 5 entries or transactions will be recorded in the journal all together with the other entries and will be recorded in the ledger in a separate account called as cash account. So that account will maintain only the transactions or the activity performed on the basis of cash. After the ledger, we will take it, the balances of the ledger will be taken up by the trial balance. Trial balance is again a summary of all the balance, or you can take it up as a list of all the balances under the respective columns, that is the debit concept and the credit concept. So the trial balance will be divided into debit column and credit column and will be recorded as a list of all the balances from the ledger. And finally, you will maintain the final accounts, or you will prepare the final accounts for each and every accounting year. So under final accounts, you have three accounts, that is trading, profit and loss, and balance sheet. So these are the basic process through which accounting starts and ends. So within this, how we are going to analyze the debit and the credit concept is given by the golden rules of accounting. This is one of the most important part of accounting. So if you do not know this, you won't be able to do accounts at all. So after finishing the process, during the journal entries, that is during analyzing the transaction part, you have to disintegrate them into debit and credit concept. So DR denotes debit, CR denotes credit. So how you're going to disintegrate these concepts are going to be in terms of these three accounts. So all the activities which are performed over there will be sorted out within these three accounts only. One is personal, real and nominal. So if you take a personal account, receiver, that is the debit the receiver, credit the giver. So whoever receives it, their name will be debited. Whoever gives it, their name will be credited. So if you take a business transaction, obviously if it is A Limited received a check. So A is the receiver. B Limited paid the check. So B is going to be the giver. Secondly, if you take the real account, whatever comes inside the firm will be debited and whatever goes out of the firm will be credited. So if cash is coming inside the firm, it is going to be debited. If cash is going to be going out of the firm, it is going to be credited. Lastly, if you take the nominal account, debit all X, credit all incomes and gains. So if you compare these two with the nominal account, it's just going to be the ulta of it. That is, for these two, you all had the positive ones on the debit. But for the nominal account, it's a loss or an expense which we have done. And if you take these two, the credit side is going to be the giving part which is going out. But if you take the nominal account, it's going to be the ulta of it, that is income or the gain will be credited. So we will next see what are the items which are included into these three accounts to sort it out in a transaction. Let's have a look at the personal account first. So what are the items which are going to be involved into a personal account? So first of all, if you see, personal account is divided into natural person, artificial personal account and representative personal account. So natural personal account in the sense the name of a person. So you can remember name. Okay, any name. Sundar account, Bala account, A's account, B's account, etc. Artificial person in the sense name of a company or an institution. So, State Bank of India, Indian Bank of India, A Limited, B Limited. If you see carefully, a company is also, when registered under the law, is considered to be a person. Okay, therefore, artificial persons are nothing but name of the company or a firm or a business institution. Next, if you take as representative person, so these are accounts which represent a person, let them be natural or artificial, a collective representation of them. The best example to show you is outstanding expenses, or let it be outstanding salary. So outstanding in the sense, so salary, there'll be a group of people who are earning salary from your business concern. So think yourself as a business person always. So you have to pay them salary. For example, A, B and C has to be paid. But we are not paying them. We are keeping them as outstanding due. We have promised them to pay them in the future. So A, B and C are natural persons who are not being paid the salary. So they all come under representative personal account. Right? So this is the personal account, the three types, that is natural, artificial and representative. Next, we are going to see about the real account. So, real account is very simple. It is nothing but the assets of the firm. Assets in the sense the properties which the firm has and which deals with. So, these assets can be divided into two types, that is tangible assets and intangible assets. So, tangible in the sense the asset can be touched and felt. For example, land, buildings, cash, which can be touched and felt. Intangible asset in the sense the asset cannot be touched but it can only be felt. That is, it doesn't have any particular physical existence. For example, goodwill. Goodwill in the sense, goodwill means the good reputative name which a company has got. Patents and copyrights are which gives you right over that particular property, which gives you ownership over the particular property. So they are called as intangible asset. They are called intangible because they do not have a physical existence. Next, we are going to see the nominal account. This is the most easiest account of all. We do not have to remember more things in this. It is simple, expenses or losses. So if the business is going to do any expense, for example, these are going to be petty expenses only. That is small expenses. For example, paying salary to the employees, paying stationery expenses, or paying for petrol, traveling. So all those expenses which are incurred by the firm, that is, the firm is paying for it, then it will be considered as expense or a loss. Suddenly, if there's a loss in the business, it can be considered in the nominal account. Incomes in the sense, what type of income which a business may get is commission or a discount received or an interest received. If you have given money for loan to someone else, then that particular person will pay you an interest. So how long he delays to pay you the principal amount, he will pay you the interest. So that will come under an income. So when it is an income, it comes under the nominal account. So nominal account is the most easiest account to remember.